everyone, my name is Emily and in this YouTube video I'm going to explain straight line depreciation, what it is and give you a few examples so you can get your head around it. So, first things first, what is depreciation? I mean, it's a pretty confusing accountancy term, isn't it? Well, depreciation is a way of recording a reduction in a value of an asset over its lifetime. So take for example a car. You spend £20,000 on a car in year one. 5 years later, you don't expect it to still be worth 20 grand, do you? So in a set of financial statements, depreciation is a way of recording that reduction in value. Straight line depreciation is a way of reducing the value of the asset evenly over its life. It's one of the two depreciation methods used in accounting, the other one being reducing balance. If we looked at, for example, a computer, you bought it for £1,000 in year one and you expect it to last exactly 3 years. So under straight line depreciation, you would depreciate the asset evenly over those 3 years. So in effect, you would depreciate it in each year 33.3%. Let's look at an example to make sure that we understand what straight line depreciation is. On the 1st of January, Claire purchased an office table for £1,000. Now, as you can see, the depreciation policy for office equipment is straight line over 5 years. This means that the business assumes that at the end of 5 years, the office equipment will have a value of nothing. So to calculate how much to charge each year, you take the original value, so the £1,000, and divide it over the period of the depreciation. So in this case, 5 years. So we do 1,000 divided by 5. So this gives us an annual depreciation charge of £200. So at the 31st of December for each year, we now need to work out what the value or the assumed value of the table is. So if we go ahead and fill in this chart, we should be able to find out. So in year one, the cost of the asset was £1,000. Because it was year one, no depreciation was brought forward at all. So in terms of charge, let's go ahead and put in £200. So this is telling us that the value of the table is now £800. Because it is straight line depreciation, the value that you depreciate each year doesn't change. It stays the same the whole way through. So if I just go ahead and fill in this table with 200, the cost obviously stays the same. Depreciation brought forward, well, so in year two, we charged £200 of depreciation last year. So the brought forward depreciation is £200. Depreciation carried forward then becomes £400, and as we can see, the asset has now reduced to £600. We can see that at the end of 5 years, it is now reduced as nil, which is in line with their policy. So we can tell from this that this is correct. Businesses are allowed to choose their own depreciation policy, and straight line is great for assets that you expect to depreciate evenly over its lifetime. So office equipment, well, yeah, okay, you could say that straight line would be appropriate. Cars, on the other hand, are likely to depreciate more at the beginning of their life than at the end. They say, don't they, as soon as you drive a car off the forecourt, you lose 20% of its value. So in this case, you wouldn't use depreciation over a straight line basis for cars.